Welcome to Talk Tickers. Kinder Morgan's Q4 numbers are out, and boy, did the market like what it saw. The stock got a nice pop after hours. So today, we're going to dig in and figure out if this is a sign of real strength or just a little bit of after-hours excitement.
Yeah, you saw that right. A solid 2% plus jump after the bell. But you know the drill. The big question is always, did the numbers actually back that up? Let's unpack the results and see if that investor confidence is really justified.
All right, so right off the bat, let's look at the bottom line. Kinder Morgan delivered 39 cents in GAAP EPS. Now, Wall Street was only expecting 37 cents, so that's a nice clean 2-cent beat to kick things off. A very strong opening statement.
And the good news just kept on coming. Revenue was also really strong, coming in at over $4.5 billion. The consensus was way down at about $4.3 billion, so we're talking a hefty $180 million beat. That is way more than just squeaking by.
So let's zoom in on Q4 by the numbers. It was, and I'm quoting management here, a strong finish to 2025. You could just tell from the upbeat tone on the earnings call that they were thrilled with these results.
Okay, so we've got the EPS and revenue beats we just talked about. But for a company like Kinder Morgan, it's really all about the cash flow. And this is where they're an absolute machine. Adjusted EBITDA came in at almost $2.25 billion. And even better, distributable cash flow, that's the cash they can use to pay dividends, was nearly $1.4 billion. That is some serious financial muscle.
And what do you do with all that cash? Well, if you're KMI, you give it back to your shareholders. The board just approved a 2% dividend increase for 2026, which is a massive signal of confidence for management about the future. They're putting their money where their mouth is.
So the results look great. Awesome. But why? What's the actual story behind these strong numbers? For Kinder Morgan, it really all comes down to one thing: natural gas.
And hey, don't just take my word for it. The executive chairman, Rich Kinder himself, laid it out pretty clearly on the call. He said their bullish view on natural gas is grounded in reality, and they expect very strong growth through the rest of the decade and even beyond. I mean, you can't really get more direct than that. They are all in.
So where's all this growth supposed to come from? Well, they're looking at a huge 19% jump in LNG feed gas demand for 2026, plus more and more demand from the power sector. Think data centers and all that. But here's the real genius move. They're locking in this demand with take-or-pay contracts. That means KMI gets paid even if their customer doesn't use the gas they reserved. It's an incredible way to de-risk your cash flows, and it's why you're seeing those transport and gathering volumes up so much.
A strong quarter is great, but Wall Street is always asking, what's next? So let's shift gears and look at the future. We're talking about the company's guidance and the big projects they're banking on for growth.
Okay, here's their official outlook for 2026, and the word that comes to mind is disciplined. You see really steady, predictable growth right across the board. But the number that really jumps off the page for me is that net growth capex, $2.5 billion. That's how much they're plowing back into the business to keep this whole growth engine running.
So where's that $2.5 billion going? Well, a big chunk is for projects just like this one, the Trident intrastate pipeline. This is a super smart play to capitalize on all that booming gas demand right there inside of Texas, connecting supply to new power plants and LNG facilities.
And it's not just about natural gas. On the refined product side, they talked up the SFPP open season. Now, this isn't some massive bet-the-farm project. No, it's more of a surgical strike, a smart expansion of capacity into high-demand markets like Arizona and California. It's all about targeted, high-return projects.
All right, so we've gone through the numbers, the strategy, and the outlook for the future. So now it's time for the main event, the next call. Here's our official verdict on where KMI goes from here.
But first, a little bit of context is super important. Coming into this earnings report, KMI stock was actually lagging the broader energy sector pretty significantly. The XLE ETF was up over 9% on the year, while KMI was only up about 4%. So you could say they really needed a big win to change the narrative.
So, did this quarter do the trick? Did it change the story? What's our call?
We are officially rating Kinder Morgan an outperform. We absolutely believe this stock is positioned to close that performance gap and then some.
And here's why in a nutshell. First, that Q4 execution was just undeniable. They beat on the top and bottom lines. Second, their 2026 guidance gives us a really clear, bankable path forward. Third, that whole natural gas growth story, it's not just a story, it's backed by real, tangible projects. And finally, the market itself told you what it thinks. That pop after hours was a huge vote of confidence. So, this brings us to our trade idea.
If you believe in this company-specific execution story, you could consider a pair trade. Go long KMI shares and short the energy ETF, XLE. This is basically a bet that KMI's de-risked, fee-based business model and clear project backlog will outperform the more volatile, commodity-sensitive names that fill up that broader energy ETF.
Now, as always, you have to do your own research. This is not financial advice.